Hi, this is Brian Vendig, President and Chief Investment Officer of MJP Wealth Advisors. It's the beginning of May, and I thought it'd be a great time to provide a market update since we've came off of a great bounce back in the markets in the month of April after anxiety and concerns about conflicts in the Middle East took the markets down from its high to its low by about 9.1%. In the month of April, because corporate profits have come in above expectations and conflicts in the Middle East seem to be trying to find an off ramp for a negotiation for a formal truce, we saw that the markets bounced back the fastest ever after a 9% decline going back to 1950s. And I think now that we're sitting here in the beginning of May, investors are wondering, what comes next? So I want to try to answer that question for you. So I think to do that effectively, we've got to look back to last year and then play forward a little bit this year, because last year we saw different policy measures come out from the administration and Congress that was hoping to support growth acceleration in the economy. Whether you look to the July 4th tax bill, you look to deregulation for certain type of industries and other type of measures that were put into place to help to support business investment and consumer demand. Now, I think going into this year, we saw those types of policy decisions as growth accelerators. But when this geopolitical conflict happened, it really seemed that over the last month or two, those policy measures really provided more of a growth cushion to help us get through the uncertainty and the turmoil, especially when we think about a global energy shock, a supply chain disruption, and higher oil prices. So based on where we are right now, we see that corporate profits so far have been aided by 70 billion of new corporate tax cuts for the expensing of factories, CapEx, R&D, which does provide a cash flow benefit to the economy and earnings benefit, which I think is starting to kind of flow through. At the same point in time, we saw that tariffs have moved from a net tax increase in 25 to a net tax cut actually in 26. And I believe starting next week, about $100 billion of tariff refunds are going to start to flow back to companies. Now, the tax refund season is also over for consumers, but that higher increase in tax refunds year over year by approximately 150 billion, I think did provide a little bit of cushion for those that are struggling with higher energy prices and higher prices in the economy in the short term, which kind of gave us that bridge to kind of get to where we are right now in the beginning of May. Now, the aftershocks of the Iran conflict, I think still have time to kind of trickle through the economy. I don't think we're out of the forest yet on that. And also, the agreement for a truce or an end to this war is still being worked on as we speak, as I record this video. But I think there's going to be a narrow path forward of agreements. Doesn't mean everything's going to happen overnight as we should expect, since this has dragged on a lot longer, I should say, than anyone expected. But I think it's going to give the markets the assurance that they need, that investors need to kind of come back to the fundamentals, as I like to say, which is focusing on that corporate profits are expected to grow high teen double digits this year. Profit forecasts for 2027 have also been taken up, but we got to keep an eye on that, because I think a lot of those increases related to profit forecasts that were being taken up for energy companies. And I think now that we possibly have this truce playing out over the next couple of weeks in the Middle East, energy prices should come down. And as a result, we think oil will probably trade around $70, $80 a barrel. When we look out at forward contracts for energy right now, that's kind of what we see for the end of 26 and into 27. So those 27 profit forecasts could be adjusted, but regardless, they are moving in the right direction. The other thing that we see in these profit forecasts, which are super important, is that profits are still being led by tech, but we're also seeing some increases in profit in the second half of this year coming from companies outside of those Mag 7 mega cap tech companies, or those other 493, as some might call it. So to summarize, I would say right now we are at a current junction in the market, which can definitely prove to be a very pivotal moment. If growth slows in the second half, driven by supply chain disruptions related to the Iran war and a softening consumer environment, then I think investors are going to look for um, reliable sources of growth. And that kind of takes me to the Mag 7 complex right now, because as we've talked about in the past in these videos, we believe that the AI innovation trend is a boom, not a bust for the economy. But we don't want to have all your equities or all your stock pieces of your portfolio allocated just in that one sector. We're still broadly diversified between large, medium, and small, growth and value and international. But I want to talk about, around the biggest theme that we see going on this year, which we highlighted as a productivity risk to the market, which is if we're not seeing a return or productivity numbers going up in the labor market with all this investment that's happening in AI, that could be a big concern for market valuations and the economy. But right now, the dominant market narrative this year is centered around continued AI-related CapEx or capital expenditures, which has been a key driver for AI innovation, infrastructure stocks, as well as a theme of power demand that we know that's out there. And right now, the Mag 7 companies account for roughly 35% of the total S&P 500 capital expenditures, which is significant. And as a result, the sustainability of the spending coming from these big mega cap tech companies is becoming more and more increasingly critical to kind of maintain this economic momentum. So thus, my point is any signs of a slowdown should pose or would pose a challenge both in the broader market of appreciating, but also specifically to the tech sector overall. And that's why we're saying, don't just chase the momentum with some of these high flying names in the market. Stay diversified, but also the fact is we're seeing these companies still grow profits quite significantly year over year. So we want to make sure we have the appropriate exposure. Now, again, those spending levels and the durability of the spending levels is what is the most important thing to focus on. That's something that we're looking at in the second half of the year, because any reduction in investments would likely be viewed negatively across all risk assets in general. So that's kind of where we are right now with stocks. So in summary, good corporate profits. We got a labor market report coming out soon. But labor market seems to be low hire, low fire, which is kind of where we are with the policy narratives and things that are going on between demographics of the U.S., technology creating productivity for businesses, and also we have an aging demographics here in the U.S. with the baby boom generation continuing to get a little older and people retiring, between 10 to 12,000 people a day retiring, which I know is an objective for many of you listening on this call as well. And for those that have retired, you are appreciative of what I'm saying. So as we switch gears out of stocks, let's talk about bonds, because in the past I mentioned, we got to really watch the 10-year treasury. We don't want to see the 10-year treasury get above 4.5%, because we've seen in the past that that's a ceiling for risk assets. And then investors start to get worried about the flow through effects of higher interest rates impacting margins and impacting valuations for companies. Right now, we see the 10-year treasury actually staying closer to 4%, which makes sense because of the higher elevated oil prices that has caused interest rates to go up because of the concerns of inflation in the short term. But I think longer term, those inflation numbers will come down. Rates will come down, because I think the economy is set up over the next couple of years to have a slowing, growing economy. And I also think with consumers being sensitive to price, inflation's not going to get too far out of whack. We might see some increase in inflation in the short term, but longer term, I think this will this will smooth out. So the focus is item number 2 is to focus on where the 10-year is going and how that relates to fixed income and stocks in the portfolio. So that's something we're looking out for in the second half of the year. Right now, what we have done is we have a bias to high quality investment grade rated bonds, single A rated or better on average. With the higher interest rates, we did increase the effective duration of bonds in your portfolio, going from 3 years to now we're sitting between 4 and 5. But that's right, what I would call is the sweet spot or the belly of the curve for bond investors. Because if we're wrong on those inflation views, or if we get some unique changes to monetary policy with the new Fed chair coming on board in the near future, staying shorter duration will reduce any risks and reduce the impacts of interest rates going up on bonds, which could affect the price. And now finally, the last couple things I'll just mention is that in light of corporate profits and still good stimulus in the economy, which has been, again, this growth cushion, as I mentioned, we still have the midterm elections in a handful of months in front of us. That's going to be a headwind. That's something that's out there that we have to pay attention to based on history from an academic point of view. That does add a lot of volatility for stocks leading into the midterm election in October and November. But then when you come out of it, you usually see a pretty good bounce in the market. I don't see that being any different this year. So I think that's something worth noting. And I think the last thing I would just say is, around the corner in the month of June is our view. We're going to have this really interesting IPO with a company called SpaceX. And it's going to be a different type of IPO because only about 3 to 5% of all of SpaceX shares are going to be available or floating to be purchased, versus a typical IPO has about 10 or 20% of shares outstanding available for purchase in the public. And also the valuation of SpaceX might be around 1.75 trillion as compared to the typical 3 to 5 billion initial IPO offerings that are out there. That's just kind of looking at things on a historical average perspective. So right now I think we're waiting to hear on a path to this hopefully a truce in the Middle East, and then right around the corner in June we have this very unique momentous IPO coming. That could cause, I think, those two factors right there with good corporate earnings and assuming labor reports and inflation numbers don't get too far out of whack against expectations. It could cause a little bit of a melt up in the market over the next couple of weeks as we head into June and July being the next earnings season. So don't be surprised if we see the S&P 500 trading at around 7,500, 7,700 over the next couple of months. So we are being very sensitive to allocating to risk assets at this time, kind of dollar cost averaging along the way. But we are sticking with that premise of good broad-based diversification for equities, high quality bonds to mitigate stock volatility. And for specific portfolios here at MJP Wealth that we're managing for you, we are looking to maintain a commodities exposure to manage against the risk of a weaker dollar in the future, as well as volatility around commodity prices as a means to hedge for inflation. So I hope that provides a meaningful update here where we are right now. But again, if you have any questions, please feel free to reach out to a member of our wealth advisory team. And thank you again for giving us an opportunity to be part of your family, be part of your team, and always a privilege to be working with you. So thanks so much. Hope you all enjoy the balance of May into the start of summer on Memorial Day weekend, and look forward to talking to you soon. Take care. Thanks so much. Bye-bye.